begin. So good morning, everyone. I'm Alan Barrett. I'm the director of the ESRI, and it's a great pleasure to welcome you all for this webinar on options for raising tax revenue in Ireland. Obviously, a lot of attention already today in the media on the paper, so it's going to be interesting to have a good presentation on it, and hopefully we'll have time for some questions and answers and have a little bit of a discussion about the points raised. Just let you know, you may be aware of this anyway, this is part of the Institute's Budget Perspectives series. So again, you'll all remember from the old days, pre-COVID, that we used to have the annual Budget Perspectives Conference. Been doing it for over 20 years now. Obviously, we used to do it in the building, and it was always a great event and a good morning. So both last year and this year, we've just altered the format a little bit. And rather than having a group of papers together, we do them one at a time. So today's is the first in the series of this year's Budget Perspectives series. So the way things are going to work today, in a moment, I'll introduce my colleague Theano Kakoulidou. Apologies, Theano, this is the first time I've tried to pronounce your name, so apologies if it wasn't as elegant as it should have been. So Theano is going to begin the presentation, and then after Theano's contribution, Barra Roantree will give the second part of the presentation, and then we'll have a questions and answer session after that. So as ever, if you can put your questions through the Q&A function at the bottom of your screen, and you can feel free to start adding the questions, and after the presentation, then I'll do my best to moderate the Q&A. So I think that's all the info we need for now. So with that, Theano, over to you then, please.
Thank you for the introduction, Alan. Let me share my screen. I hope now you can see it. Okay, so let's begin today's webinar. Together with Barra, we'll present you options that a future government that wishes to increase tax revenue could consider, as well as their distributional impact and their economic implications. But I should clarify that we do not present a best option, or do we advise which of the options are better suited. This is for policymakers to decide. Our aim is to present the options that are available, stating the pros and cons of each. A little background first. Okay, so spending rose from 87.2 billion in 2019 to 106 billion in 2020, mainly due to COVID-related expenditure. And but our paper is not set as a response to such increases. COVID-related spending is wisely financed from a temporary budget deficit. This kind of economic response is appropriate to the nature of the pandemic, and such spending should not be withdrawn prematurely, as noted by a number of international organizations, such as the OECD and the IMF. At the same time, though, spending pressures and structural budget deficits exist irrespective of the pandemic. 2021's budget raised non-COVID spending by more than 5 billion, and government has already committed in reforming the health system and expanding social welfare entitlements, something that could potentially lead to new needs for financing. Additional to this, the volatility of corporation tax receipts, as well as successful green initiatives that could lead to lower motor tax receipts, raise concern and raise the alarm about future tax increases needed in the years ahead, as noted in the recent IMF report. I will continue with presenting you some information about tax revenue and some options about broad-based tax increases that could be considered, whereas Barra will continue with the options for the better off and for restriction relief and exemptions. So, starting the discussion about tax revenue, the first question that might come to your mind is how revenue evolved throughout the years. So, in this graph here, we can see the share of revenue, the revenue as a share of GDP and how they evolved throughout the years. And having this picture in mind, we might come to the conclusion that the situation is horrific, that revenue deteriorated from a peak of 34.4% in 1988 to the lowest level that existed in 2019 to 19.4%. But as it's widely argued, GDP is not the correct measure of comparison. A better way to examine the revenue and share of revenue is as a share of modified gross national income, GNI star, something that we will see with this graph here. As we can see here, revenue remained almost unchanged throughout the years, with only a small decrease a slight decrease from an average of 34.3% in the 80s and the 90s to an average of 32.7% in the recent years. So the next, we have seen how revenue evolved. The next question that might arise is how revenue, from which sources are collected. Here we have all the sources that revenue are collected from, and as we can see, income tax and universal social charge, VAT and PRSI account for almost 70% of revenue, and adding to the sum receipts from corporation tax, we have almost 86% of the budget. We can come to the conclusion from that any government that wishes to raise substantial sum of revenue, it will be difficult to avoid increasing any of these taxes. So the first options that we will present to you is options that are broad-based and affect a significant number of the population. And the first one that someone can start examining is taxes on income. Each option that I will present to you in this and the next graph estimates the effect of 1 percentage points increase in the tax rate, in the different tax rates examined. In the graph here, we will see the distributional impact of the increase. For our analysis, we have split households in 10 equal-sized groups, from the lowest to the left to the highest in the right. And in the vertical axis here, we can see the loss of disposable income that households in each group will experience due to the 1 percentage point increase. In the labels above, here we see which tax we examine and also the revenue yield that we expect from its option. The first option examined is the potential increase in the income tax rate. In each option that we will see, the darker shade is a lower rate of the tax examined, and the lighter shade is a higher rate. So here we see that increasing the income tax rate, the standard rate from 20 to 21%, and increasing the higher rate from 40 to 41%, we expect about 1 billion of revenue, and the average household will experience losses of about 1% of their income. Increasing universal social charge rates, here with this blue bar, we can see that we could have 1 additional billion of revenue, and income losses will also be about 1%, whereas increasing employees' PRSI and self-employed PRSI, we expect a little bit less of revenue yield, about 810 million, but the average losses will be also of about 1%. Here we examine the distributional impact, and we see that all options presented here are progressive, with higher income households experience significant losses than the lowest income households. We can see that the highest income household experience losses of 1.5%, whereas the lowest income households experience losses of 0.2% when we examine the income tax rate increases or the universal social charge increases, and losses of 0.4% when we examine increases in the PRSI. It should be noted though that increasing any of these tax rates is expected to affect financial incentives to work, to discourage financial incentives to work, and to disincentivize savings. Contrary to increases in the income tax rates or the universal social charge rate, choosing the government to increase PRSI rates would result in income losses only for the working age population, as pension income is exempt from PRSI. Okay, so the next option that could someone consider and examine is increasing consumption taxes, with the first one being the VAT. Increasing by 1 percentage point reduced in standard VAT rates could raise about 690 million in revenue, with income losses of about 0.3% for the average households. But we can see here that this option is regressive, with lower income households experience losses of 0.6%, whereas higher income households experience losses of a little bit over 0.2%. This analysis, though, might be misleading. Lower income households spend more than their income compared to other households, and thus pay higher amount of VAT, but they cannot spend higher amounts of their income forever. A possible explanation is that these households are experiencing only temporarily low income and finance their spending through savings or borrowing. For consumption taxes, it is worth examining the distributional impact of increase as a share of expenditure as well. As we can see with this new blue bar, here we examine the losses that a household will experience as a share of expenditure, and now the increase seems to be distributionally neutral, but even in that case, highest income households experience a little bit less losses compared to other income households. Naturally, after VAT, another possible option that could be examined is increasing excise duties and the carbon tax, with a 10% increase in all rates could raise about 600 million, but the burden will mostly fall to lower income households. Such taxes, though, are designed to discourage consumption of products that are seen as damaging for the individuals and the society. The rate usually is set in such level as to correct externalities. Behavioral responses, thus, are not so concerning as with income tax increases that we examined earlier. Additionally, if the policy that these taxes aim is successful, revenue from these sources will decrease. For that reason, considering increasing excise duties or the carbon tax rate is not suited for increasing revenue in the medium to long run. The last option that we consider and is affecting a significant part of the population is increasing the local property tax rate. The first option that someone could examine is increasing the rate with an increase of 15% estimated that could yield about 72 million. But another option worth exploring is updating the property values. Local property tax is levied on the assessed market value of the residential properties, but property values have not been updated since 2013. Whereas households of newly built owner-occupied dwellings are currently tax exempt. Updating the property values could raise 275 million, affecting mostly those who have seen substantial capital gains in recent years. So these were the main broad options that could be considered, and I give the floor to Barra to continue with the rest of options examined.
Great, thanks very much, Theano. I will just get my screen up now and hope this works fully. Can you see that okay? Yeah, I think that's good there. Okay, so Theano's going to talk you through some of the broad-based tax increases. And one of our other main sources of revenue is corporation tax. So, another option kind of somewhere between kind of a broad-based tax increase and maybe a more specific one is on increasing the main rate of corporation tax. However, it's not really clear what that tax increase could yield. So revenue don't provide a costing of this for the very, very good reason that it's very, very uncertain. So we know the receipts are highly concentrated amongst a small number of firms. The latest data show that in 2019, 51% of corporation tax receipts came from just 10 companies. So what that means is that, corporation tax receipts are very sensitive to the decisions of those 10 firms and additional amounts from some others as well. But as a result, it's not really clear what we would actually get from increasing the main rate of corporation tax. So there's just a lot of uncertainty around that kind of depends on a few number of actors. Increasing corporation tax would, like any other tax, have economic effects. In the case of corporation tax, we know from research done by the ESRI and others that it would affect investment and would discourage it, and particularly foreign direct investment. We know that's particularly sensitive to the rate of corporation tax, and what that could lead to then, an increase in corporation tax might have knock-on implications in terms of less foreign direct investment and then in terms of less income tax, for example, in future years. But it's not just foreign firms that would pay the higher corporation tax. We might also see domestic firms invest less because the net of tax return is reduced, and that would also have economic effects. There's, again, a lot of uncertainty around these things, but these aren't trivial, and so there are trade-offs that need to be considered. In addition, while corporation tax is, of course, remitted by corporations, the burden of it will fall on people. And some of that burden is likely to fall on workers, consumers, and retirees for various different reasons. So in the case of workers, well, if there's less investment, there's going to be less capital, workers are going to be less productive, and that's going to feed through to lower earnings. Recent research from Germany suggests that something of the order of a third of corporation tax increases could fall on workers through that form. Consumers could also face some of the burden through higher prices, with firms passing on the increase in corporation tax through to higher prices. And in addition to kind of shareholders who kind of rely on investment income, who are working age, retirees and current retirees and future retirees who have pension funds would also be affected, as those pension funds are often the owners of these companies and rely on the dividends and change in share prices for their income there. So there would be other economic effects from increasing corporation tax, and those are important to bear in mind. Perhaps though actually the most important issue to consider here on corporation tax is just that the international environment is in such flux. So we have the OECD base erosion and profit shifting process nearing maybe agreement on the current strand. At the same time, we have the UK and the US talking about raising rates for the first time. The UK have legislated for that after decades of cutting rates. They're now going back up. So those things could go in different directions. The higher rates in the UK and the US might allow for us to raise the corporation tax a little bit without really affecting international stuff. But that really depends on how that international agreement pans out. And so from that point of view, there may be an argument for leaving the rate and structure of corporation tax unchanged until the implications of the international agreements are really fully understood. And that could be a few years' time. But there's just a lot of uncertainty on this one, and we don't want to kind of come down on, and I think that's important to bear in mind. So a future tax-raising government could also, rather than focus on broad-based tax increases, could also decide it wants to raise those taxes mostly from higher income people. So various ways of doing that. We go through many in the report. Just going to pick out 3 here. So one is that you could increase and here I'm showing you again a decile chart like Theano showed you, where lining up households from lowest income on the left to highest income on the right, and showing you losses from various measures as percentage of disposable income. And again, if we look at the existing USC surcharge on non-PAYE income, if you increase that by 1 percentage point, you raise about 14 billion, pretty much all of it coming from the highest income tenth of households. Really no one in the lower deciles, in the lower half, or even 2/3 of the income distribution affected by that. However, that's only levied on PAYE income. It's not necessarily clear why you want to have a USC surcharge that only applies to non-PAYE income. If you were to introduce an equivalent 3% USC surcharge on employment income above 100,000, that would raise quite a lot more, raise about 110 million is the estimate. Again, that would mostly come from really the higher income households, the highest income tenth in particular. But USC isn't the only tax on income. You could also introduce a new 43% rate of income tax above 100,000. That revenue estimate would raise something like 315 million a year. It would again come from predominantly the highest income households. In this case, it would go little, it would affect some households in the 8th and 9th decile as well, because essentially income tax applies to joint income for married couples, whereas USC applies for universal. So again, there's a range of options there if one wanted to focus tax increases on higher income people. But these also come with the caveat that we go into in detail in the paper about, we know that higher income people are more responsive to taxes. But a lot of that's down to their ability to change the form in which income is taken. And so, that could be because they're able to take their income in the form of capital gains instead of as personal income. And so from that point of view, you might want to think of doing these things if you wanted to increase taxes on higher income people simultaneously with changes to the capital gains tax rate or structure. And from that point of view, thinking about here company owner managers who are able to shift the form that their income is taken away from labour income or kind of employment income and hold it in the company and then draw that down as capital gains later in time. That's something which is increasingly important to other countries and likely the case here in Ireland as well. So in addition to people with higher income, you could also focus the tax increases on those with lots of wealth or inheritance. We go into a wealth tax in the paper. It's something that's going to be mentioned quite a lot, and there's a lot of attention to it. There's a big report actually came out in the UK Wealth Tax Commission, which goes into a lot of issues which are probably quite similar. But really where we kind of highlight on the wealth tax point is that if you're going to have a recurrent tax on wealth, you really need to exempt very few people or sources of wealth to raise substantial revenue. And that's a point really made by Martina Lawless and our own colleague here at the ESRI and Donald Lynch at the Department of Finance when they did some work on modelling this a few years ago. But once you start to exempt significant numbers of people or sources of wealth, you really aren't going to raise that much revenue. And the reason for this fundamentally is because 90% of household wealth is held as property. And the majority of that in turn is the primary residence. And so really what that means here is that, even for the top 10%, household wealth is really the primary form of wealth. Property wealth is really the primary form of household wealth. And so if you're going to exclude that, you're just not going to raise very much revenue. However, most property is already all residential property is subject to the local property tax. And so from that point of view, rather than try to reinvent the wheel, there's maybe a case for instead adjusting the rates or bands of the local property tax. That could be very much be tailored towards whatever distributional objective you have. If you want to focus that property tax increase on wealth tax increase on millionaires, you could do so by the higher rate of the local property tax applies to the value of property above $1 million. So that's probably the best instrument to look at from the wealth tax point of view, if you do want to look at recurrent wealth tax. There's other issues related to that we go into in the report and would encourage you to look at that if you're interested. However, there probably is more scope to raise taxes on the transfers of wealth. And something we kind of highlight in the paper is that capital acquisitions tax, which is our tax on inheritances and gifts over a lifetime, that really is paid by a small number of people receiving large transfers of wealth. So we go into the paper that that there's about just under 15,000 transfers of inheritance which have CAT levied on them at the moment each year. There's about 30,000 deaths, and given that each death is usually associated with more than one person getting an inheritance, what that means is far less than half of deaths lead to an inheritance that's subject to CAT. Again, if you look at the stats on capital acquisitions tax, you see that the average payee of the Group A threshold, that's inheriting from their parents or their kids, they'd received over their lifetime around 600,000 in gifts. So really, capital acquisitions tax or inheritance tax is predominantly paid. It's paid by a very small number of people receiving very large. You could do that in several ways. One, you could increase the rate of the tax. It's currently 33%. You could increase that. You could also reduce the tax-free threshold, at which point you start to pay tax on inheritance. So at the moment, it's 335,000 a year. You could reduce that down to 250,000, where it was a few years ago, or lower. That would raise about 63 million. And again, you could raise more from that if you accompany that by an increase in the rate. However, there's also actually quite a lot of exemptions to capital acquisitions tax in particular. And that's something we go through in the report as well. I'm just going to give you an overview of some of some of the ones that we pull out there. But they're really, because of these reliefs, there is the potential to improve the design of the tax system while raising revenue. And the reason for this is that many of the reliefs that exist are poorly targeted at achieving their stated aims, or don't really have a very solid underlying economic rationale. So just to pick out a few of these, and again, we'll go into more detail and more of these in the paper. But for capital acquisitions tax, there's something called business and agricultural relief. Now that cost about 360 million in 2019, and what it is relief that reduces the value of any family business or family farm that's being passed on from a parent to a child by 90%. It's not capped, and then the idea of this is to encourage succession within small business or farms, but it's not capped. So lots of the gain actually goes to those inheriting large businesses or large farms. So for example, if you have you can pass on a farm worth more than 3 million euro to a child without paying any inheritance tax because of the design of this. Commission on Taxation 2009 called for this to be restricted and recommended reducing the rate of relief. That could be one way of raising some of that revenue, but there is a lot there in terms of that relief. And again, it's not particularly well targeted towards the small businesses and farms it's supposed to encourage. Another one that we point to in the report is the 200,000 tax-free pension lump sum. So there's no longer any figures on that, but in 2014, the last year that was available, that cost about 134 million. What the tax-free lump sum means that you can, when you retire, take up to 200,000 without paying any income tax. It's not clear how that aligns with kind of the goals of policy, because what the aims of pension policy really are to encourage people to have an adequate income in retirement. Not clear how kind of a 200,000 tax-free lump sum at the point that you retire is doing that. And so it might be better to you could adjust the taxation of pensions in a way by looking at that if you're looking again to raise revenue. We also flagged the role of the Help to Buy scheme, which has cost about 100 million a year, and as we mentioned before, researchers at the ESRI and others mentioned it's not particularly well targeted at those people who need support. A large number of the claimants already had the 10% deposit that they needed to buy a place, and so used the Help to Buy to reduce how much they borrow or they buy somewhere larger. It also seems to be directed primarily not in the cities where you might think that high construction costs are what are leading new build homes to be expensive. That almost 50% of homes built in new homes built in Leitrim availed of Help to Buy in the last year. We have a map on that just to show you where kind of Help to Buy is particularly helping, I suppose, around the country. And 100 million in 2018. It's a blanket reduced rate of capital gains tax for people who own certain types of business. It's not particularly well designed towards spurring entrepreneurship. And actually, we kind of copied it over from the UK. There, they've heavily restricted that relief, as well as renaming it Business Asset Disposal Relief, or BAD relief. So maybe something to be looked at there. Finally, in terms of how do we improve the design of the tax system while raising revenue? So something that OECD and others have drawn attention to in recent years is the tax-favoured nature of self-employment compared to employment. That's very true here in Ireland. The reason for that is there's no equivalent of employer PRSI, which is somewhere around 8.8 to just over 11% of pay for employees. So there's no equivalent of that for the self-employed. Now, one reason often given for that is, again, well, we want to have lower rates of tax on entrepreneurship and to encourage businesses. But again, blanket lower tax rates are poorly targeted entrepreneurship. There are very clearly issues with entrepreneurship that we might want to encourage. So, for example, innovation and R&D, we know not enough happens because you get spillovers and people can't capture the entire returns from their investment. But again, R&D tax credits are kind of the way to deal with that problem. In terms of financing issues, there's more targeted ways of encouraging entrepreneurship and the limited access to finance that they might have, rather than kind of a reduced blanket lower rate of tax. Another reason that has been advanced for why self-employment might be tax favoured is traditionally being, well, they don't get the entitlement to the same contributory benefits. That's no longer true. So recent reforms in the last few years have meant that the self-employed now have very, very similar access to contributory benefits as the employed, 93% in value terms, according to a report from the Department of Social Protection recently. And so from that point of view, it's not clear that really there's any justification for those very, very reduced rates of PRSI that are associated with self-employment compared to employment. Equalising rates could raise a lot of money, could raise more than €1 billion. Now, again, one wouldn't do that overnight. This would have to be a gradual thing, and particularly in the aftermath of COVID. But again, this kind of points to the potential to improve the design of the tax system while raising revenue, given that, again, the OECD and others have pointed out that having these very tax differentiated forms of employment gives rise to people essentially just undertaking self-employment because it's more favourably taxed. And that's not something that really the tax system should be encouraging. So that's just kind of an overview of some of the key findings of our report. Again, the report is about 70 pages long, and we go into lots of these in more detail. We go into other options, and hopefully there's a useful particular table and figure at the end of the report, which sets out all the revenue that might be raised from the different measures, and also the distributional impact of all of those that we can model. So do encourage you to look at that. In terms of broad conclusions, I think, really the main lesson that we take from the report is that, there is a clear need for substantial tax increases in the coming years. That's very likely if we want to fund the spending commitments that are kind of being talked about, and the increases in, the reforms to healthcare or the increase in social welfare entitlements, and particularly given that we have some forms of tax revenue which are likely to reduce in future years. So corporation tax is likely to be some reduction there, and motor tax, which currently accounts for about 3.5 billion in tax revenues, all linked to fuel. There are many ways to focus those tax increases on the better off, but really what we talk about in the report is that if you're going to do that, you're going to struggle to raise substantial revenue, and you set those tax rates at very high rates. And then that's where you start to get the issue of, well, certain forms of wealth are particularly mobile. Higher income people have more scope to change the form that their income is held in. So there's maybe kind of, a limit to how much can be raised from just taxing the better off. So from that point of view, it is relatively straightforward, though, to raise substantial revenue by increasing those broad-based taxes on income, consumption, and property that Theano talked you through at the start. There are billions that can be raised there from increases to the rate of the standard and higher rate of income tax, from increases to VAT, and from increases to local property tax. And again, those can be tailored with any distributional goals in mind. So, we don't come down in favour of saying one should do it this way or the other way, but the range of distributional objectives that might be out there, from neutral through to progressive or even regressive, you can achieve that with those main tax instruments. You don't need to focus everything on the very top, or new rates of tax, the very top, in order to achieve a progressive outcome, if that is your aim. We also, the report highlights a wide range of anomalies in the current tax system. And one thing that we kind of flag is that actually these create distortions, and they create distortions which raising rates of tax alone could amplify. That's something which you might want to be careful about. And from that point of view, actually, addressing these anomalies could raise substantial revenue. And it could do so while leaving the tax system better designed for the coming decades, and I suppose more able to raise revenue from other places by removing those distortions. So that's where we'll kind of finish up with on the overview of the report. Again, do encourage you to, if you're interested, to download the report from the ESRI website and go through it. We didn't want to it's 70 pages there. We didn't want to try to take you through it all. So we've just taken some of the main highlights from that, and look forward to hearing your questions now.
Great, thanks so much, Theano and Barra. So again, I'm just going to remind people, if they want to start submitting questions through the Q&A function, I'll start passing them on. Can I start with just one question, and either of you can try and answer it? And it's really a broad contextual question around a lot of discussion now around this notion that maybe we've overemphasized concerns around deficits and such like, and that a new view currently on the even you could say the desirability of deficit spending. So are you being over alarmist in terms of the need to raise taxes? And let me quickly add that in asking questions, I'm not suggesting that I have a view on the answer. I just want to hear you talk about the issues that I
Sure. So yeah, as you say, there's, I think, less concern about deficits, and particularly that's been seen in terms of the ability of governments to borrow to smooth through to the gigantic COVID shock that we're seeing now. And very much, the paper isn't about, well, we need to pay for COVID and the costs incurred from that. We can probably live with a higher level of debt than we previously thought we could, and we can probably in general live with a higher level of borrowing than we thought we could. However, what the paper is kind of pitched around and kind of focused, and we go through this in the introduction of the paper, is that there really are some substantial spending increase kind of penciled in for the future years. We have an aging population, which we know is going to result in a lot higher expenditure in healthcare and transfers and pensions. We know that there are some significant sources of revenue which are going to dissipate over coming years. So not just corporation tax, which hopefully, will only be something of the order, 2 billion hopefully will be a good outcome from that, and we won't have a lot more disappearing from that. That's the 2 billion figure the Department of Finance have kind of penciled in. But we have 3.5 billion in tax revenues a year, which are raised on motor taxes, which come from fossil fuels, which we have said we want to move away from. So this is really kind of in the longer run that, if we're going to have this higher level of spending that's kind of being put out there, and there does seem to be this emerging consensus around having more spending and larger state, it's not clear that is going to be able to be paid for by a lasting and very, very large budget deficit. But that's not to disagree with the idea that we're probably more comfortable with larger deficits than we would have been before this year or last year.
Okay, and it's just a related question then from Donald Butler. Have you made a specific estimate of how much we need to raise?
No. So we specifically haven't, because I think that's the type of thing. Well, one that our colleagues elsewhere in the institute are probably better placed to make. But this is more just, and again, to an extent, that not that that's fully a political decision, but how close you want to run to the wind in terms of with a higher level of debt or with deficit is to some extent a decision for others to decide. And what we're really trying to do in this report is to set out options where we're talking about essentially large numbers, but it's up to policy. It's a menu of options there for people to consider.
Okay, and a more technical question from Donald. When you do the analysis of VAT, do you assume that VAT is fully passed on in terms of prices? Or is there any absorption by firms?
Yeah, so we do. We assume it's passed on prices, and there's some research kind of on that seems to show that the increases in VAT tend to be passed on, but reductions don't. That there's a bit of asymmetric incidence in terms of how VAT has been passed on. There's some recent research on that. So, it probably won't be passed fully on, but at the same time, we do think that a lot of the increase in VAT will be shifted in prices.
Okay, and it's more comment really from Paul Sweeney, who's talking, of course, you talked about motor taxes, but I mean, carbon taxes generally, if successful, okay, in terms of reducing emissions, should in a sense sort of contract as a revenue source over time. So that's just another point to be taken. There's an anonymous attendee has asked a question. I was going to ask the same one myself, so let me again run it by you with no suggestion that I'm suggesting that this should or shouldn't be done. But it was previously identified that one of the defining features of the Irish income tax system is the extent to which we exclude low-income people. And it was always a sort of something that ministers of finance trumpeted, that they were taking so many people out of the tax net. But my understanding is if you compare our situation to other countries, that the point at which you start paying tax is higher than elsewhere. So is that still a sort of a fair comment about the nature of the tax system? And does it raise the question then that one of the options should be bringing more people into the tax net, even maybe at a sort of a lower rate? Yeah,
so in short, yes, the Irish income tax kicks in from a relatively high level. If you look compared to other European countries, so it's in effect for a single adult about 16,000, something around that order, that you then start to pay income tax at. However, we do have the USC as well, and that kicks in from a lower level. We have the PRSI as well, which kicks in from a lower level. So it's not the case that those are entirely exempt from tax. But yes, you could very much lower the income tax threshold and bring more people into the tax net. The pattern of that would be, essentially less progressive than increasing rates of income tax. But it's not. It's unlikely to be regressive because again, the people at the very bottom of the income distribution don't have anyone in their household who's earning enough to pay income tax, even if you reduced that threshold significantly. So that is another option. We didn't go into it, I think, to try to keep the paper on under 100 pages, which was already kind of getting unwieldy, but it is very much an option that people could consider.
Okay, thanks for that. And again, Theano, just jump in anytime you want, including contradicting Barra. That's allowed, indeed encouraged. Okay, so question from Robert Short, and he's saying, can you ask when you think tax increases will be needed and by how much? And also, can the curtailment of reliefs ever match what could be raised through the main tax heads?
So on the second bit of that anyway, I think that's one of the things we kind of draw on the board, that there's lots that can be done there. There's lots of reliefs which aren't particularly well targeted maybe towards their objectives, what they're supposed to achieve. And there's, there is money to be raised there, and serious money, but it is hard to raise the type of revenue that you can get from just increases in those broad-based taxes. And that's kind of what we're getting at in the report as well, is that it's, it's very hard to raise billions and billions from restricting those reliefs, whereas one could imagine doing so through broad-basing taxes on an income, consumption and property.
Okay, now I'm going to read out a comment, stroke question from Neil MacDonald from ISME. So I don't know if you can see these, Barra and Theano, but anyway, I'll read it for the audience and then you can react or not. So Neil's referring to page 19 of the report. He says, the commentary on the USC surcharge on the self-employed makes no sense. Right, blunt. If they declare income over 100,000, they pay a surcharge on it that PAYE workers don't pay. If they under-declare income and keep it in the country, they are avoiding tax. Audit is the solution, not punishing all who declare high income with a surcharge. So any reaction to that?
Yeah, so I'm not sure what bit of the commentary that they're referring to on not making sense, but I mean, what they point to in terms of the ability of some company owner managers to keep revenue within profit within the firm and draw it down in different forms is something that we talk about extensively in the report. It's one of the ways in which that we know that higher income people are able to reduce the tax that they pay is by shifting around the form that income is held and shifting it over time. So that is important. In terms of audit, I agree that there's probably more that can be done on our audits. There's again some research which shows that in the UK context, random tax audits reveal that quite a large proportion of those who are randomly audited, so this is not because of any risk or kind of factor brought in, but just completely random audits, a very large share of people are non-tax compliant and for often quite sizable sums. So there very much could be a role for audit to increase revenue. But again, you're probably talking there kind of tens of millions rather than necessarily the kind of hundreds and billions that might be considered in future years.
Okay, now almost inevitably, I suppose, when you start discussing taxation, then a whole plethora of issues are coming through in the questions, which is fair enough. So Wayne Stanley has another question. So do the speakers have any thoughts on the role of ring fencing as a means to making taxation more palatable? So I guess that's hypothecated taxes is the issue there. In favor or against?
I think in general the economist's answer is against, and I think that's for two reasons. Either the hypothecation is imaginary and it's kind of essentially just a meaningless in that we say that we're hypothecating stuff but we're not, and because money is fungible and goes into the one pot. So in a way that sometimes you could think of what we do with PRSI as that we put money from PRSI into the social insurance fund, but in years where the social insurance fund doesn't have enough to pay out, we top it up from general taxation, and years where we've got spending too much relative to that, or in years where we have too much money in there, we store it as investment. So you can have that kind of hypothecation, in which case it doesn't make much sense. Maybe it might be useful from a communications point of view, but that's not one for the economists. But from the point of view actually of hypothecation, where you do have binding hypothecation, it actually matters. And so that you might consider this if we said that, okay, well, X% of PRSI revenue is going to be on training or something like that. Or what that can lead to is a situation where when revenues plummet, you suddenly have to stop spending on things that you would like to maybe spend more of. So again, in the example of training, if we hypothecate some share of tax revenues from employment for retraining programs, well, we really want retraining programs during a recession when revenues are falling. So I think that's kind of like reasons that economists tend to come out against hypothecation for kind of two broad things. Either it doesn't particularly mean much, and again, it might be useful communications, but that's not really our field, or it is meaningful and it leads to bad outcomes.
Okay, very good. I'll read another question now from our colleague, Emer Smith. And this links back to something that came out of the Citizens Assembly a number of weeks ago. So how can your research be used to challenge the assertion that making the rich pay is a real solution? So the recent Citizens Assembly overwhelmingly committed to paying higher taxes to pay for the services needed for childcare and elder care. So there may be a wider willingness to pay for services than previously thought. So I guess this is this ongoing issue. I mean, I think the number of times I've heard groups of people who, in a hypothetical sense, said they were willing to pay more taxes for a whole variety of things. But I'm never entirely sure if that actually translates. I don't ever remember people voting for tax increase. Now, maybe I'm wrong, and I don't mean to be flippant about it. But Barra, Theano, any reaction to that on issues around willingness to pay? And is there the case in Ireland that we're demonstrating a greater willingness to pay?
Theano?
Okay. It's true that up until now, we know that people are really hesitant in paying more taxes, but we are in a new environment. The pandemic has changed also the way that people think. And there's a new upcoming literature that see how the pandemic affected choices of the individuals. So we have to see increasing in spending in this new environment. And also, I think what we should also highlight is that reforming the tax system and restricting reliefs and the things that we highlighted in the report, all these anomalies, could also help to make the people more willing to pay, because they also will see that there is a different tax system in total, that everyone pays a little bit and there are not that significant number of exemptions that exist up until now.
Okay,
but I think you want to add also.
No, just I suppose, we've often seen the role of government expand and be financed, I suppose, in the aftermath of big events. And so the pandemic could turn out to be one of those. We saw that after the world wars, that really a larger state became a thing, and people paid more tax as a result. So we might see that, we might not. But certainly of the kind of, the spending commitments or plans that are being made, it look likely that they're going to require something like that.
Okay, housing always comes up in some shape or form. So Brian Purcell has a two-part question. I hope Brian doesn't mind if I just focus on the second part. Would increasing PRSI rates on landlords, so he thinks 4% on rental income over 5,000, would that be likely to affect housing supply or increase rents if any increase was passed on to renters? So any thoughts on landlord tax?
Yeah,
I guess so, PRSI was extended to them then a number of years ago. Yeah,
so I mean, I suppose one of the issues there is that we know that lots of the smaller landlords are kind of recently there've been a reduction in the number of landlords altogether, and that seems to be because of some smaller landlords leaving. There's no real evidence on how sensitive they are to changes, so the elasticity, their responsiveness to taxes, we don't really have any good evidence on. It could be a certain channel, but I don't think we have any idea of the scale of that and whether it would lead many to leave or not. So it's not something we have, I think, strong evidence on. But that is a plausible channel, but I don't think we can say anything about how substantial that might be. In general, in terms of, I think Brian also asked about just how responsive people are to those contributions, and the evidence on this is that not hugely, in essence. So I've done some research before in looking at kind of what are called notches and kinks in the tax schedule, where you don't see essentially much response to those taxes, and so there, it's not clear that necessarily that will lead to big changes in employment or number of hours worked or the like.
Okay, and another one actually related to properties rather than housing, but obviously they're totally interrelated. How does Ireland's local property tax rates and exemptions compare to other jurisdictions? And then specifically, are we underutilising a good revenue raiser, stroke wealth tax in LPT?
So our local property tax is on average a lot smaller than many other countries. So I think on average the payment was something like €260 in the latest statistics. So it's relatively small with other countries. We have, I suppose, our experience has been similar to some other countries, the Germany and the UK, for example, in finding it difficult to revisit valuations. So, we were meant to revisit these valuations, as Theano said earlier, in 2016. That's been kind of delayed repeatedly. And one of the things I think that we see from the experience of other countries, again, Germany and the UK, where they're still levying the property tax on valuations made in the 1990s, is that this just gets harder to do the longer you leave it. The bigger the revaluation you have to make, the harder it is to do it. So it's better to do these things early and often.
Is there evidence too that the low property taxes feed into higher house prices?
Yes, there is some on that, and we go into that a little bit in the paper, that there does seem to be some pass through into into the prices of property. So from that point of view as well, one could think of higher property taxes as having kind of financial stability benefits, in that it might reduce the volatility of house prices, and particularly if there's credit issues there or that. So it is something that might have been useful, say, in the 2000s, that if there was a larger, more current property tax then, rather than the reliance on stamp duties.
Yeah, I mean, that thought struck me, and I might be wrong about this, and you can correct me if I am, but some of the pressure, when you were talking about inheritance taxes, from memory, there was some pressure to increase the thresholds because there was a recognition that with increasing house prices in Dublin, it meant that the tax burden was higher. Am I right in saying that? There's a sort of a funny interaction.
Yeah, well, so actually, what I think an important point on the capital acquisitions tax is that, unlike lots of other countries, we have quite a sensibly designed capital, tax on transfers of wealth, which is that it's the person who's receiving the wealth that pays the tax, and they have a lifetime limit on any gains or transfers given. So, in some countries they have an inheritance tax where you can essentially avoid it all by transferring wealth more than 6 years before you die. The Irish one is well designed in that sense, that applies to transfers over a lifetime. But one of the issues is that it's often talked about, well, a threshold of 335,000 means that you can't inherit a average home in Dublin, say. Well, an important consideration there is that it's on threshold is for the person inheriting. So it's only the case of a loan of a single child that they'll be inheriting that property all themselves. We can hope that in families where there's multiple kids, that they might all get some kind of share of that. And so in that case, if you have 3 kids, the current thresholds mean that that a house worth almost $1 million can be more than $1 million can be passed on tax free as stands. So that's an important, I think, thing in relation to that what you say.
Okay, so listen, we're kind of approaching the end. I think maybe I didn't say it at the start. We normally go for about 45 minutes, so we're about 5 minutes over. But there's just one more question that I do want to put you. It's from Jared Turley. Are you being too pessimistic about how much a wealth tax would bring in?
So I think this is really drawing on Martina's work on this with Donald Lynch and the Department of Finance. And the thing that they really highlight there is that once you start to get those exemptions, and if you exempt any, particularly if you exempt property from that tax, you're going to raise very little. And from that point of view, again, if you're going to exempt property and have high threshold, you need a very high rate from the wealth tax to raise anything. But then what you're levying that high rate on is the more mobile forms of wealth. And so I don't think we're being too pessimistic. I think we're just being kind of realistic that property is the most realistic form of wealth to tax, because it can't move. It's very hard to anyway. So from that point of view, really, most of the wealth tax is about a property, and we already have the local property tax, which I think we're maybe more optimistic on how much you might be able to raise from. So that's I think really the point that we're making, that a wealth tax is about a property tax, and maybe it's better to use the LPT.
Okay, so listen, there are extra questions, but unfortunately we're not. I think normally what we try and do is save the questions, and maybe the authors would be willing to email people bilaterally or whatever like that, and we can keep the discussion going. So look, I want to congratulate the two of you on a fine presentation and a fine paper. I think it's just a sense, but because we've been so consumed by the pandemic, and everybody is talking about, well, obviously you're not going to raise taxes in the middle of the current circumstances, which makes perfect sense. But I think as a result of that, the discussion on what's going to happen post-pandemic, and I think some of the things you've been talking about, I think they're really, really important, and I don't think there has been enough discussion. I think there's a blunt reality possibly here about the need for tax increases. So I think beginning a discussion on what form those may take has been a really sort of valuable public service that the two of you have provided. So I just want to congratulate you both. So listen, thanks to the two of you. Thanks for everybody for logging on. We'll have a second budget perspectives paper around the middle of June. I think the date is yet to be confirmed, but obviously we'll email out through the usual routes, and hopefully we'll have a good group for that presentation as well. So with that, I'll say goodbye and wish everybody a good rest of the day, and indeed a good weekend. Bye-bye.